Welcome back to the Deep Dive. Today we're diving into a really highly polarized investment story. It comes to us from our listener, Stock Analytics AI. We're talking AppLovin Corporation, ticker APP. A company with huge scale, recently added to the S&P 500. And as of the market close on October 6, 2025, the stock was sitting at a pretty staggering $587.
Right, a massive valuation.
But the real reason we're digging in today is this central, almost explosive tension that's just ripping through the narrative right now. Is AppLovin like truly the undisputed mobile advertising powerhouse? Shielded by its superior AI and these elite margins.
Or the whole thing, the entire business model, facing what some sources are calling an existential threat.
Exactly. And that threat comes from a formal SEC probe into their data collection practices.
Yeah, and that probe isn't just, background noise. It's a genuine crisis. It triggered a 14% stock plummet in one day. So our mission today is really to cut through the hype and also the fear and give you, the listener, the core facts. What's APP's business about? What about those amazing financials? And crucially, what are these severe, maybe unquantifiable risks driving the story now?
It's a perfect storm, really. Technological brilliance meets regulatory peril.
So let's start maybe with just understanding what they actually do. What do they sell? Because it's easy to get lost in all the ad tech jargon.
Absolutely. Good place to start. Let's announce it clearly.
Yeah.
Chapter 1, Business Understanding. Okay, so AppLovin isn't really selling consumer apps anymore, not directly. Think of them more as the fundamental plumbing for the whole mobile app economy.
Right.
They operate this two-sided marketplace. So on one side, you've got the demand-side platform, AppDiscovery, that helps advertisers find exactly the right users for their apps or products.
Targeting.
And then on the flip side, there's the supply-side platform, AppX. This helps the publishers, the people making the games and the apps. It helps them maximize their ad revenue through these real-time auctions.
Okay, so they connect the advertisers with the app makers.
Exactly.
And the secret sauce that lets them do this perhaps better than almost anyone else is their own proprietary AI. It's called AXON 2.0.
Right.
This machine learning engine, from what the sources say, it's genuinely superior. It's apparently what allowed them to achieve that recent explosive growth because it's just better at predicting user behavior and, optimizing ad spend.
And crucially, wasn't that the engine that helped them navigate the huge disruption from Apple's ATT changes, the app tracking transparency stuff?
Exactly. That was a massive test for the whole industry, and AXON 2.0 seems to have passed with flying colors, allowing AppLovin to adapt when others struggled.
And that adaptation, that tech focus, was also part of a bigger strategic pivot they made, right?
Yeah, they used to own a bunch of gaming studios.
Right.
But they've been selling those off, divesting those assets to focus purely on this higher margin software, the ad tech business.
Makes sense. Focus on the core strength.
Yeah.
And just recently, October 1st, they launched a big new tool, Axon Ads Manager.
Ah, the self-serve platform.
Yeah, exactly. It's designed to put that powerful AI tech into the hands of potentially millions of smaller businesses. So not just the big enterprise clients anymore. It could significantly widen their customer base.
And that kind of laser focus, combined with their scale, creates what looks like a durable competitive advantage, a moat. It's built on network effects.
Explain that a bit. The network effects.
Well, think about it. AppLovin has immense scale. They process, get this, $11 billion in gross ad spend in just Q1 of 2025.
$11 billion in one quarter.
Yeah. That scale feeds Axon just vast amounts of data. More data makes the AI smarter. Smarter AI delivers better returns for the advertisers.
Which attracts more advertisers.
Exactly. And more advertisers means more value for the publishers using Max. It's a classic flywheel. It just keeps reinforcing itself.
And the market they're in, the mobile ad market, it's enormous, isn't it?
Huge. Projected to grow from roughly $263 billion today to over $1 trillion by 2032.
Wow.
That's like a 21% compound annual growth rate.
Yeah.
Massive tailwind.
But, okay, let's not forget the competition. It's intense, right? Google AdMob, Meta's audience network.
Oh, absolutely. Intense competition. And there's always that constant looming headwind from the platform owners, like Apple making changes like ATT, or regulators bringing in things like GDPR. Any change to the rules can really throttle their data supply.
And that constant threat to the data, well, that leads us directly to the leadership, doesn't it? The ones now facing this huge test. Chapter 2, Management Evaluation. Okay, so the company is led by its co-founder and CEO, Adam Forey. He owns about 11% of the company, which is significant.
Founder-led.
And it's interesting, his background is actually in derivatives trading. And you can kind of see that maybe in the aggressive, founder-led style you see in their strategy.
Yeah, that trading background. It makes a certain kind of sense when you look at how hard they push the boundaries, both potentially in data practices, but also definitely in capital allocation. Look, the management team has basically been in crisis mode for a little while now, even before this SEC probe.
Right, the short seller reports.
Exactly. Earlier in 2025, short sellers like Fuzzy Panda, Muddy Waters, they made some pretty serious allegations, talking about deceptive practices, things like fingerprinting, improperly copying data, stuff like that.
And management's response?
Forceful. They hired a big-name law firm, pushed back hard denials.
But then, the major turn. Just days ago, October 6th.
Yeah. The U.S. SEC launches a formal probe, specifically into AppLovin's data collection practices. This is the potential existential threat we mentioned at the start.
And what's the focus?
Potential violations of platform service agreements.
Okay, in plain English.
Those are the rules set by Apple and Google for playing in their sandbox, basically, for operating on iOS and Android. If the SEC finds they've violated those rules, a negative finding could theoretically lead to being restricted or even blacklisted from those ecosystems.
What?
Essentially kill their core business model. So yeah, this probe forces a really critical look at the leadership's integrity and their risk management.
And you mentioned the aggressive mindset is also reflected in their capital allocation.
Oh, absolutely. Look, they don't pay a dividend. Instead, they've executed one of the most, frankly, extreme share buyback programs I've seen.
How much?
Roughly $5.5 billion over the last 3 years.
$5.5 billion on buybacks.
Yes. And get this. That represents 100% of their free cash flow during that period.
Wow. So every dollar of free cash they generated went into buying back their own stock.
Every single dollar. That is management betting absolutely everything on their own stock price continuing to rise. Massive conviction, you could say.
At a massive risk.
Well, yeah, it's a high-risk gamble for sure. Using 100% of your free cash flow for buybacks instead of, say, paying down debt faster or investing even more in R&D, that strategy really only pays off spectacularly if the stock keeps going up. And it amplifies the risk from their debt, which we need to talk about.
Okay, but there must be a reason for that confidence, right?
Oh, there is. Their underlying financial efficiency is, frankly, astonishing. Their return on invested capital, ROIC, it exceeded 40% in 2024.
40% ROIC. That's elite.
Absolutely elite. It shows incredible financial productivity. Which brings us nicely to the financials themselves.
Chapter 3. Financial analysis. So that astonishing efficiency you just mentioned, that 40% ROIC, it explains a lot about the market cap, doesn't it? Exploding to $231 billion by October 2025.
Right.
It was only $13.4 billion at the end of 2023. That kind of run-up, that wealth creation, it's just stunning. It creates this huge excitement, maybe even euphoria around the stock.
Which probably makes the downside risks feel even more jarring when they hit.
Definitely.
And the sources show this phenomenal V-shaped recovery in their growth numbers. Remember how revenue growth kind of stalled out? It was just 1.1% in 2022, mainly due to that initial shock from Apple's ATT changes.
Yeah, the whole industry felt that.
But by 2024, AppLovin's growth surged back to 43.6%.
Wait, hang on. From 1.1% growth to nearly 44% in just 2 years.
Yep. It really proves that the Axon engine adapted incredibly well. And then, get this, in the second quarter of 2025, revenue jumped 77% year over year. 77%. That's not just recovery. That's like hitting hyperdrive. That kind of turnaround is almost unheard of, especially in ad tech after ATT.
And the profitability metrics, they just reinforce this picture of an absolutely elite software business. Huge margins. We're talking 79.3% gross margin.
Wow.
And a 55.6% operating margin for the trailing 12 months ending June 2025.
Incredible. So almost 56 cents of operating profit for every dollar of revenue.
Exactly. And that profitability converts directly into really robust cash flow, about $2.9 billion in free cash flow over that same trailing 12-month period.
Okay, the numbers are undeniably impressive. Powerful engine, massive cash generation. But let's look at the potential dark side of those aggressive financial moves you mentioned earlier, the leverage.
Precisely. This is the core financial risk here. Leverage. They carry a high debt profile. The key metric is the debt-to-equity ratio. It's currently sitting at 3.0.
Okay, unpack that. 3.0 DE. It means they have $3 of debt on their balance sheet for every $1 of shareholder equity. Well, it's an aggressive stance. It really amplifies risk if growth were to stumble or if interest rates stay high.
So while their short-term cash flow looks strong now,
Yeah, their current ratio is 2.74, so short-term liquidity seems okay.
that overall debt load still looms large, especially with rising rates.
It does. And crucially, there's the valuation. It is extremely stretched, that TTM PE ratio of 93.8x.
Nearly 94 times earnings.
Yeah. That's more than double the PE of established, profitable tech giants like Salesforce or Adobe.
So you're paying, what, over $93 today for every dollar of profit they made last year?
Exactly. It represents an extreme bet on sustained, high-level future performance.
Is there any sense of intrinsic value? Like what the fundamentals might suggest it's worth?
Well, one educational discounted cash flow, or DCF, model mentioned in the sources suggests an intrinsic value range somewhere between $290 and $420 per share.
Okay, so $290 to $420 compared to the trading price of $587.
Yeah. Significantly below. Now, DCF is just one model, very sensitive to assumptions, but it strongly indicates that the current price leaves absolutely zero margin for error, zero room for disappointment in growth execution, and zero room for a significantly negative outcome from this regulatory crisis.
Okay, so speaking of zero margin for error, we really need to flip the coin now. The financials demand perfection. What does the market actually think about that huge regulatory risk hanging over them? Let's dive into Chapter 4, Market Sentiment.
Well, interestingly, Wall Street analysts, generally speaking, are still pretty bullish. The consensus rating is a strong buy, with 21 out of 25 analysts recommending it.
But was there maybe some caution baked in already, even before the SEC news broke?
It seems so. The average price target, even before the probe news, was around $611, which was actually below the stock's recent highs. So, yeah, maybe a little hesitation was grouping in.
And then the SEC announcement just shattered that confidence.
Absolutely. Triggered that immediate 14% one-day decline. Huge reaction.
And technically, where does the stock stand now?
Well, from a technical analysis perspective, that big drop pushed the price below its 50-day moving average. That's usually seen as a short-term bearish signal.
Okay.
But more critically, the stock is now testing, or was testing around the time of the source material, the absolutely vital 200-day moving average. That sat right around $592.
And why is the 200-day so important?
It's widely watched as a key indicator of the long-term trend. A sustained break below that level would be a major negative technical signal. It would suggest to many chart watchers that the long-term uptrend is fundamentally broken.
Okay. And you mentioned earlier there was already some skepticism, maybe reflected in short interest.
Yeah, that's right. The short interest, the percentage of shares borrowed and sold short by investors betting the price will fall, was reported between 5.05% and 6.10% of the float.
And how does that compare?
It's notably higher than the average for its peer group, which was around 3.63%. So, yes, it suggests that a decent chunk of bearish investors were already wary, likely due to the high valuation and maybe those earlier short seller reports about data practices. They were already positioning for a fall.
Interesting. Okay, so that's market sentiment. What about who actually owns the stock? Chapter 5. Ownership structure. Well, institutional ownership is pretty high, right? Around 65.3%.
It is, but a lot of that is likely passive ownership now because of the S&P 500 inclusion. You know, huge index funds like BlackRock, Vanguard, FMR, they just have to own it as part of tracking the index.
Okay, so maybe look past the passive index funds. What about insider activity, people actually running the company?
Yeah, that's where it gets more cautionary. Well, the CEO, Adam Forey, still holds that significant 11% stake.
Right.
The overall pattern of insider transactions over the last 12 months looks pretty negative. Heavy net selling.
How heavy?
The sources noted 116 sell transactions versus only 37 buy transactions by insiders.
Ooh, that's not a great look. Suggests those with the deepest insight might feel the risk-reward isn't compelling anymore, especially at those high valuations before the drop.
It certainly raises a flag, and it ties back to the leadership style. That concentrated ownership structure, with the founder holding a big stake, it allows management to make really bold moves, right? Like these massive buybacks we talked about.
Yeah.
But the flip side is it also carries this inherent risk of potentially reduced accountability if those strategic decisions, especially around risk management, like their beta practices, turn out to be fundamentally flawed. Less checks and balances, perhaps?
Okay, so that brings us neatly to summing up all these risks and strengths. Chapter 6, Risk Assessment. Let's do a quick SWOT-style breakdown.
Okay, sounds good. Let's start with the internal stuff. Strengths and weaknesses. Strengths. Clearly, the superior AXON 2.0 AI engine. That's stunning 40% ROIC. The massive network effects from their scale And, of course, the robust free cash flow generation.
Hard to argue with those. What about the weaknesses?
Well, the big one is the high financial leverage, that 3.0 debt-to-equity ratio. There's also still some revenue concentration leaning heavily on the mobile gaming sector, which can be volatile.
Right.
And then the core witness exposed now, the alleged questionable data practices. That's the direct source of this SEC probe crisis.
Okay, now the external factors. Opportunities.
Huge potential there. Expansion into massive new markets beyond gaming like e-commerce, that's a big one they talk about.
Right.
And leveraging that new self-serve platform, Axon Ads Manager, to reach potentially millions of small and medium-sized businesses globally. That could unlock a whole new growth vector.
That can make sense. Now, the big one, threats.
Yeah, and the main focus here has to be the regulatory scrutiny and legal risk from that SEC probe. It is the immediate, potentially existential threat.
Why existential? Remind us.
Because a negative outcome isn't just about paying a fine, though that could be substantial. It could force fundamental detrimental changes to the core Axon engine itself, their secret sauce.
Undermining their key advantage.
Exactly. And crucially, it could seriously damage or even sever their essential partnerships with the platform gatekeepers, Apple and Google. If Apple or Google restricts AppLovin's access to user data or limits their ability to serve ads within apps, the business model essentially collapses.
Okay, that's stark. Are there other external threats?
Yeah, even without the probe, there are macroeconomic factors, high inflation, high interest rates. They generally put pressure on advertising budgets across the board. That hurts revenue.
And it also increases the cost of servicing that big debt load AppLovin carries.
Precisely. It's a double whammy from the macro environment.
So, yeah, we really do have two completely competing universes contained within this one stock. Chapter 7, Conclusion. So how do we synthesize all of this? What's the takeaway?
Well, AppLovin just presents one of the most, maybe the most polarized investment cases on the market right now. It's really stark.
The bull case. It rests entirely on that technologically superior AI, the Axon engine, and those truly elite financial metrics, right? That 40% ROIC, the huge margins, the cash flow.
Yeah, the bull case basically demands you believe that this incredible engine can keep delivering sustained, say, 25% plus annual growth for many years to come, and that the tech advantage is durable.
Okay. And the bear case?
It's almost entirely dominated by that single, unquantifiable, but potentially existential threat, the SEC investigation.
It overshadows everything else on the negative side.
Pretty much. So the valuation reality, even after that 14% drop, took the price down to $587. It's still demanding a lot.
What specifically is it demanding?
It's basically demanding that investors bet on two things happening simultaneously. First, that this massive growth machine keeps humming along almost perfectly. And second, that this whole SEC drama resolves itself with minimal material impact on the business.
That feels like a big ask. Both things have to go right.
It is a big ask. The market right now is trying to price in that continued operational success because the numbers are amazing, while also trying to somehow discount this severe but completely uncertain negative outcome from the probe. It's a real balancing act.
So the concluding thought, the key question for you, the listener, to really mull over is this. Is the exceptional, genuinely game-changing performance we've seen from the Axon AI engine, is that truly enough to compensate for paying a premium valuation and taking on the risk of a crisis that challenges the very integrity, the very foundation of the business model?
That's the billion-dollar question, isn't it? Or maybe the $231 billion question.
Well, thank you again to our listeners, Stock Analytics AI, for providing the source material for this really fascinating deep dive into APP. We covered a ton of ground today, a real roller coaster. Remember to like and subscribe to Stock Analytics AI. We really appreciate it. Members who join for €4.99 a month get priority deep dives on tickers. We're planning to cover all the S&P 500 stocks over the next few months, and members get that exclusive priority access.
And hey, if you just want a one-off deep dive on a specific stock you're interested in, just drop us a super thanks on the platform. We'll definitely see it. And of course, we have to include the critical reminder. This analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice.
Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.